Hello, everybody. A warm welcome to all the participants in this presentation on the subject Indian income tax planning for NRIs. The financial year, the tax year of India got over on 31st of March 2026, which was the financial year 2025-26. And now a lot of compliances are due in respect of the year which has ended. Then the new year has started from 1st of April 2026, which is the new year, which, as we know, will end on 31st of March 2027. So we are at a cusp where we need to do all the compliances in respect of the year which has gone by, and we are looking at the year which is before us. So in this presentation, what we have tried to do is we would be covering the entire spectrum of compliance in respect of the year which has gone, and all the tax planning and tax optimization related strategies which could be implemented in the new year. These words will commence the presentation. Start the presentation. First, I would like to share a couple of minutes in respect of the present Indian tax administration system. The present Indian tax administration system is a system where, as we all know, that all kinds of filings of taxation is completely e-filings. There is no physical filing of any tax returns or any forms. Then all the assessments and appeals have become completely faceless. Moreover, all the transactions which a person would be undertaking are mapped with the permanent account number, which is the TIN number as we call it in India. And these transactions are warehoused or are sorted by the income tax department on the basis of whatever has happened in respect of the financial transactions of that person in the earlier year. Now, there is no scope of any personal interaction with any authorities, and that is what is the norm of the day. And this has led to a major change in the functioning of the entire income tax department. These changes have been ushered by the Prime Minister, Mr. Narendra Modi, way back in the year 2020, when COVID was in vogue and in full swing across the world. And he devised and he rolled out a system whereby these interactions would not happen, entire system would become digital. So it is at least by this time, around 5 years plus, this system is operative. The good part and the experience that we had on account of this entire system is that whatever were the kinds of justifications or whatever were the kinds of just behavior which is expected from any tax administration are now what we see are definitely available. We have come across through several kinds of inquiries or notices which have been issued, but the moment the SSC has complied with those notices and have given satisfactory replies to those notices have definitely been settled. And our experience in respect of dealing with the department in its new version has been very positive. The net effect of this has been that in India, the parallel economy, which was prevalent since several years and several decades, is now on a decline. And we are moving towards a cashless and a compliant economy. Insofar as the impact of it on the growth and development of the country is concerned, the government revenues on account of this new administrative system have become much better, and the tax to GDP ratio, which is a very critical and important ratio for looking at the way the government's finances are, is definitely getting better year on year. This year, the Indian Income Tax Act 1961, which was operating and was applicable since all these years, is now replaced by a new law of income tax, which is the Income Tax Act 2025. The provisions of this new Act, Income Tax Act 2025, will be operative from 1st of April 2026. So all the compliances in respect of the earlier year, which has ended on 31/3/26, be in accordance with the earlier law. Now from 1st of April, which is the current year, the new law would be applicable. But we need not worry for the fact that this is a new law, for the reason that the new law is just something which is a renumbering or a substantial adoption of the old provisions and renumbering of the provisions with new simplified language and structure. So materially, there has been, we can say, no changes in the new law. The only thing is that the section numbers, the form numbers, and the rule numbers are now changed. The question which comes up in minds of everybody when we talk about compliances is that who all would be required to file their tax returns for the year or the financial year which has ended on 31/3/26, which is the year 25/26. The simple answer to it is that when there is any income which is accrued, arised, or has been received in India, are always liable to income tax in India, irrespective of the fact that that person is a resident or a non-resident. So for the non-resident Indians, those incomes which, as I said, accrue, arise, and are received in India are always liable to taxation in India. Now, who all are required to file their tax returns under the new regime of income tax? The person who has an income in excess of 4 lakhs of rupees is the person who is supposed to file tax returns. And if a person wants to claim a refund of the taxes which have been withheld or it has been deducted, then naturally one needs to file a tax return to claim this refund. Then if somebody wants to claim that they have incurred a loss and that loss is supposed to be carried forward in the subsequent years, to be set off in those subsequent years, then one needs to file their tax returns. Moreover, if there are certain transactions of a substantive nature which has been undertaken by that person, then also one is supposed to be filing the tax returns. These transactions which I am talking, which are of a substantive nature, have been narrated in this slide, which is there on the screen as of now. So only in these circumstances, one is supposed to file the tax returns. Otherwise, the mere fact of holding a PAN number, one is not required to file the tax returns. Now, the question which definitely everybody needs to seek answer to and keep in mind is that what are the circumstances under which one would receive any communication or the cases could be selected for any kinds of tax assessments. Broadly speaking, there are 4 situations in which any tax return which has been filed, one might receive any communication from the tax department. The first thing is that if the return itself, which was due but was not filed, then you definitely receive a communication from the department. But if the return has been filed and there are certain high value transactions which have happened, and the income and the details filed along with the return of income do not correspond with the kind of those high value transactions, then the department or the income tax department might send a communication and seek explanation in regard to that. Then, if in case, if whatever are the incomes which have been known to the department and which are quite available for viewing for the person who is filing the tax return through the annual information statement or taxpayer information statement or the statement which was earlier called Form 26AS, where whatever were the incomes and the taxes deducted are put forward by the income tax department on the website in the account of the respective taxpayer. If those transactions not a part of the tax returns which are being filed, then one might definitely receive a communication or a letter of inquiry from the tax department. And last but not the least, and quite important, especially for non-resident Indians, that if there are any credits in the Indian bank accounts from outside of India, and the nature and source of those credits seem to be doubtful to the income tax department, then one might receive a communication to explain these situations. Barring these situations, lot of returns are, or rather practically all the returns which are filed, irrespective of the size of income which is disclosed or kind and the level of transactions which are, those returns are automatically processed by the system and they are not disturbed and they do not receive any communication or any inquiry from the tax departments. So, in sum and substance, anybody who is filing the tax returns, they need to be cognizant of these aspects, which can definitely lead to a scenario where their tax compliances go absolutely smoothly. Now, we would like to throw light on one of the most important topics, which is very relevant insofar as non-resident Indians are concerned, which is the double taxation avoidance agreement, the entire framework of it, and what are the benefits that you can derive out of these DTAAs. In order to understand the DTAAs and what could be the advantages of it, and why these DTAAs are structured in the first place, one need to understand the principles of taxation. Now, these principles are principles which are applicable across the globe. Whatever be the income tax act in respect of each country, each jurisdiction, they are based by and large on these rules and principles of taxation. The first rule, the source rule. Under the source rule, whatever are the incomes which are generated by a person in any jurisdiction, the country from which those incomes are sourced have the first right of taxation in respect of that income. So, if somebody who is a non-resident Indian based out of the USA and they are deriving any income from, say, India, the UAE, or maybe the UK, the first right of taxation will be that of India, UAE, and UK. Whatever are the taxes due in respect of the incomes which are sourced from that country would be liable to taxation in that country in the first place. Then the another rule or principle of taxation is the residence rule. The residence rule says that anybody who is a tax resident of a particular country, in that country, one is supposed to offer the entire global income for taxation. So if somebody predominantly staying in the US and by virtue of that, that person is a tax resident of the US, in US, over and above the incomes which that person has earned in US, one is supposed to offer to tax the incomes which are earned in India, UAE, and UK, everything as a part of the global income. Then they need to pay taxes in the US in respect of that entire global income. So the question which arises in the minds of everybody is, and the practical difficulty which happens is that the incomes which were sourced from India, UAE, and the UK, they have already suffered the taxation in respective jurisdiction on account of the source rule. Now, if I'm supposed to offer this income for taxation in the US and pay taxes on the global income, then that income which was taxed by those respective countries is once again taxed. So, in order to see that this anomaly or this kind of double taxation does not happen, the double taxation avoidance agreements are signed between different countries. Today, India has DTAAs existing with 97 major countries of the world. And over and above the relief of double taxation, there are ways and means, or there are different clauses or articles under the DTAA. Even reliefs are available on account of concessional rates of tariffs or concessional rates of tax which are living under the DTAA. And as we all know, these DTAAs become important for the reason that global incomes and global assets are mandatory to be reported in countries, especially like USA, UK, Australia, and now practically so many countries of the world. The way the entire relief of double taxation is worked out is that in the example which I put, the moment somebody is offering to tax the global income in the country of residence, then all the taxes which have been recovered by the country where the income have been sourced from, those taxes would be given as a relief from the taxes when the final taxation is happening in the country under the source rule. To explain and illustrate, in the example which I gave you earlier, that when the non-resident is filing the tax returns in the US, and in respect of which global taxes or on the global incomes taxes are supposed to be paid, then whatever are the taxes which have been paid in respect of that income in India would be deducted. UAE does not tax individual income. So if there is no tax which has been deducted, then there is no relief which is available. UK also, where I have paid the taxes as a non-resident Indian, they would also be deducted. So when I'm filing my US taxes, I can claim a set-off or deduction in respect of the taxes which have been paid in the countries where from these incomes are sourced. In order to claim this relief, the way we support from our offices in respect of our clients is that the tax years of the country from which the incomes are sourced, say for instance, India, starts from 1st of April and the tax year, financial year in India ends on 31st of March. While as the tax year in the US starts from January to December, in other countries from July to June, then they require the calculations to be in their respective currencies. So when there is an income which is generated in India, it is supposed to be offered to tax in the US or Australia or for that matter, any country, then it has to be in accordance with their tax year, in their currency, and the reflection and the filing has to be in the format which would be in respect of that particular country. And the tax credits which are available for the income which are commensurate to that part of the year have to be claimed. So when they receive this kind of a comprehensive report, then the compliance becomes very convenient and seamless. This is just a snapshot or a glimpse of the basic structure by which we provide this entire reporting. This is the top page, the annex, the detailing of the various annexures which would be contained in the international tax compliance report which is supplied by us. So it would contain separate annexures for the separate incomes which have been generated. And as I said, they would be they would be in accordance with the tax year, the currency, and the requirement, which would be in respect of those countries where the tax filings have to be made. So it acts like a plug and play kind of a report when the taxes are filed at the time of aggregation of global income in the country of residence. Then the another relief, as I said, available to anybody who is a non-resident is concessional rates of taxes. So the way it works is that whenever there is a local law and a DTAA, both of them existing side by side, a non-resident Indian can pick and choose and claim to be governed by the beneficial provisions. Just to illustrate, say the taxation on India in respect of dividends is, say, 25%, right? And the rate of tax which is available by way of concession is in a particular agreement or particular DTAA is a lower rate, then the non-resident Indian can opt to be governed by the lower rate rather than the tax rate, which is that of the local law. So I might be paying tax on interest income as a part of my regular income at maybe 30%, but somebody who is from UAE might pay tax on that interest income at just 12.5% because he has the option of selecting the rate of tax which is beneficial, which is available under the DTAA. The same holds true for several incomes, and each one of the DTAAs govern these kinds of concessional rates of taxes. In certain cases, in certain incomes, there are certain incomes which are completely tax-free under the DTAAs. And the most prominent and the one where one can take a lot of advantage is that in case of countries like Kenya, Uganda, Singapore, and various other countries, under the DTAA, all the gains in respect of any kinds of mutual funds, may be equity, debt, or even in case of category 2 AIFs, all the incomes, whether be it short-term, long-term, completely tax-free, because that is what is provided under the DTAA with that respective country. Even concessions are available in respect of pension incomes for pension incomes which are generated in India, and the person who is on the other side is a non-resident based out of these countries. In order to claim this relief of zero rate of tax, especially in case of Indian mutual funds, the way it works is that on sale of the mutual funds, the asset management company will deduct the taxes, and those taxes will be in the form of withholding taxes, which would be deducted. Then the non-resident Indian who wants to claim the relief under the DTAA need to obtain a tax residency certificate from the country where he is based out, and that tax residency certificate, along with form number 41 in India, is to be filed along with the tax return. The moment this filing is done, the Indian income tax authorities are informed and they understand that the person who is filing the tax returns in India is asking for being governed by the DTAA, and then the relief is granted for the incomes which are tax-free in India, in this case, the capital gains on the sale of Indian mutual funds. And the refund in respect of whatever taxes have been deducted are granted to the person who is the non-resident. This is something, the entire process is completely digital in India. And yes, it definitely works, and funds are granted to non-resident Indians with this process. With these words, I've been talking of a lot about how one would be paying taxes. Now we'll be looking at the another interesting part of the presentation, which everybody of you would be definitely interested in, that how can we plan our tax affairs in the manner that we can optimize our tax liabilities. I request Rajit to take forward the balance part of the presentation.
Very warm welcome to all the participants who have joined from different parts of the world. It's an honor to address you and empower on the different aspects as far as financial planning for the Indian diaspora is concerned. Before we move forward, I wanted to mention that the entire presentation, which we are presenting, will be available to you in form of a PDF file, so that you can access it at your own convenience, and you can reach out to us if you have any further questions. You are requested to mention the contact details in the feedback form that we'll be sharing later on in the presentation, so that we can share with you in form of an email or WhatsApp, whatever is convenient. Moving further with the planning as far as the taxation is concerned, there are three different avenues which we normally work with NRIs as far as tax planning is concerned. First is by creation of a Hindu undivided family. Second is by dividing incomes and investments between different heads in a family so that the entire tax liability is optimized and spread across different heads. And third is through the relatives who are living in India. Hindu undivided family basically is a creation of law, Hindu law in India, and a HUF is created automatically on the marriage of a Hindu male. The person who is this Hindu male is called as Karta in the technical terms, and this HUF is a separate person as far as the income tax laws are concerned, meaning it has a separate bank account of its own, it has to obtain a PAN of its own, and that is why we can divide the incomes which are earned so that a person can divide and distribute certain incomes in a tax efficient manner at lower rates of tax, because we have a progressive tax liability, as in how the incomes increase, the individual, the tax rates also increase. So by dividing the incomes, we can take advantage of the basic exemption limit, and if at all it crosses the basic exemption limit, the rate of tax is lower. One thing important to note here is that now Aadhaar card is mandatory for the Karta start for HUF, without which it is not possible. And this HUF entity has got different interpretations as far as the local tax laws of several countries such as US, UK, and Australia are concerned. So NRIs who are situated in those countries, it is advisable that we do not create this kind of structure, but for all other persons in different parts of the world, this can be a very effective tax planning. The second avenue is by dividing all the incomes between the different members of the family. Let's say if there are four different members living in a family, then the investments can be spread and divided in a manner that incomes which are taxed at the slab rates, meaning the rates of tax which are progressive, as I mentioned, they are divided in between different individuals. So all the different incomes that could arise out of the investments in any of the manners, let's say by way of rent or interest or dividend, which is taxed at the slab rates, is spread across different family members. So the overall tax liability is mitigated. There is no income tax in India till the basic threshold of 4 lakhs of rupees, even for a non-resident individual. This is a tax-free limit which every head, every family member can be assigned, and incomes to that level can easily be apportioned that particular person. For any capital gains arising out of equity markets, be it the shares or mutual funds, there is an annual exemption of 1,25,000 rupees, which can also be availed by every individual. So by dividing in the family of four, which I mentioned, there can be a total tax-free capital gains, long-term capital gains of 5 lakhs of rupees, which can be attained. This is also a practical scenario and a case study of tax planning that is done by many of the NRIs across the world. If there are funds which are there outside of India, which are invested in India, then those can be gifted to relatives living in India, which are parents or any other relatives whom they trust. And then these people, residents of India, can invest those money wherever they feel appropriate, especially in financial assets. And there is a system of nomination which is done in these kinds of investments along with a specific will for these investments. So the succession part is safeguarded for the NRS. And thereafter, at a later date, whenever these investments are redeemed, there is income which is arising out of these investments. There will be tax implication in India because the incomes are derived by a Indian tax resident and is sourced from India naturally. But the advantage is that there is no taxation in the country of residence of the NRI. Let's say if someone is situated in US, because these funds are gifted to an Indian resident, there is no tax implication that will arise in US because the investments are no longer under the ownership of the NRI. Thereafter, later, whenever the investments are redeemed, then the Indian resident can remit up 250,000 US dollars per person per Indian financial year out of India, through which the funds can reach back to the NRI. Or what can happen is that if there is unfortunate demise of the person who is the resident relative, then there is something called as transmission, meaning succession of the investments that happens, and then the successors, who is the NRI, whose funds these, who owns these funds, will receive these in the NRO account, after which it can be remitted outside of India to the extent of 1 million US dollars per person per Indian financial year. So this way, the entire tax liability of the appreciation till the time the resident relative is active in India can be shifted to to India, and it can avoid the tax implications or even the reporting requirements for all the persons who are outside of India. There are many individuals who are planning to return back to India, living outside of India since several years. There are several points that they need to keep in mind to mitigate the tax liabilities not only in India, but also in the country of residence. Whenever a person who has been living outside of India for a very long period of time, at least 5 to 10 years, who has been a non-resident, returns to India, then there is a tax concession up to 2 to 3 years, depending on the stay in those 2 to 3 years, which the Indian government has given in form of a residential status of a not ordinarily resident individual. What happens is that during this tenure, whatever are the incomes that are arising outside of India by way of investment incomes, let's say by way of sale of investments in form of capital gains or rental or interest, all these investment incomes outside of India during these 2 to 3 years are not taxed in India. So what we suggest a lot of returning NRIs is that this is the best time to liquidate all the assets outside of India so that there is no tax implication in India, and whatever are the realizations out of these sale proceeds, those can be then channelized to India, and thereon, whatever is the appreciation, India has the right to tax. But all the accrued gains, whatever is unrealized, till the liquidation happens, until this window of 2 to 3 years, someone can enjoy the tax-free gains out of any assets. This could be real estate, financial assets, or anything else. Secondly, it is important to create a HUF, because once a person returns to India and stays for a period of at least 182 days in the coming 12 months, then that person becomes eligible to have Aadhaar. Or if a person is an Indian passport holder, then the person can right away obtain Aadhaar, through which the HUF can be created if it is not done earlier, which can help to divide the incomes between the family to reduce the overall tax liabilities. Thereafter, as I mentioned, the division of income principle also holds true for tax planning for any person who is returning. And additionally, for all the residents who are under the income tax residents of India, there can be a tax-free holiday up to 12 lakhs of rupees. The way we mentioned that till 4 lakhs of rupees, there is a basic exemption limit for any NRI. Any person who is a resident like us living in India can have this tax-free incomes under slab rate of income, which is any kind of income, including interest, dividend, rent, or even other professional or business income, up till 12 lakhs of rupees. So that could lead to a substantial tax-free income between the entire family if we keep adding the 12 lakh limit for each of the family members. And the last point is about updation in the income tax record. Once a person obtains Aadhaar, it is important and mandatory to link it with the PAN, and it is also necessary to update the residential address and the residential status in the online income tax portal, which is the only means now to engage in any kind of income tax compliance for the individual, may it be filing of returns or filling any other forms or tax assessments or whatsoever. Moving further with the second part of tax planning is relating to the different investments through which the tax planning can be done. All these are different and popular avenues which are often used by NRIs to diversify their investments in India. We will understand as to what is the best tax planning strategy that can be adopted for each one of these investments to reduce the overall tax liability. Starting with mutual funds, which is the most popular means for investing in the Indian equity market through a managed route. There are two different options which can be selected in case of a mutual fund investment, which is the growth option, wherein whatever are the earnings, they are reinvested automatically in the corpus. And second is the ICDW option, wherein whatever is the income, to a certain extent, it is distributed back where there are dividends in the equity shares which are distributed. The growth option has got tax incidence at the time when the units of the mutual fund are ultimately sold under the head of capital gains tax, which is there at 12.5% for long term when the holding period exceeds 1 year. While in case of this ICTW option, there is a flat rate of 20% for NRIs for whatever income is earned. So someone can opt for the growth option to reduce the tax liability. Secondly, there is as I mentioned earlier, there is an annual exemption of 1.25 lakh of rupees on equity gains. What can be done is that the portfolios can be reviewed every year, through which gains to the extent of 1.25 lakh of rupees at least can be booked, so that the entire portfolio is agile and we take advantage of the changing trends in the as far as the investments are concerned. And at the same time, we also book the gain to the extent of at least that amount without any tax incidence. If we do not book it, then we lose that limit. And in the coming year, there will only be a fresh limit of 1.25 lakh that will be available. The limit that we have lost in the past years may not be available. Systematic withdrawal plans are also very important tools through which regular incomes in a very tax efficient manner can be generated. And this is a very popular means now for so many of the individuals for whom we plan the retirement incomes or certain steady incomes that they want to enjoy for a very long time. As we discussed earlier, HUF can also be created so that HUF has its own limit of 1.25 lakh of rupees while investing in mutual funds under its own identity. Arbitrage funds and hybrid funds are also efficient vehicles which have got certain tax advantages, so that the temporary funds can be parked in the arbitrage funds. And basically, the idea is that with that kind of a temporary parking money, we get taxation at a flat rate of 12.5%. As I mentioned earlier, SWP, systematic withdrawal plans, are a very popular means. This is a practical illustration of for one of our clients that we have done to withdraw regular incomes in a very tax efficient manner. In a corpus of about 87 lakhs of rupees, the person who was requiring about 7 lakhs of rupees per year, which is around 8 to 9% of the overall corpus. What we have done is that we have started a SWP of 58,000 rupees a year, a month, sorry, so that there is an annual amount of 7 lakhs of rupees which can be attained. And every month, whenever we sell units which are proportionate to the value of 58,000 rupees, then there is a certain amount of gain that happens. This may not happen in a linear pattern as illustrated because the equity markets are volatile, but definitely across a longer time frame, this could tentatively be the gain with different ups and downs. Then if we add up the entire gains for the entire year for all the months, then it is lesser than 1,25,000 rupees in this case. So the entire withdrawal of 7 lakhs of rupees is practically tax-free at appreciation of about 12 to 13%, what has been illustrated in this scenario. Even if we are likely to continue this further, whenever the entire corpus accumulates and the gains are proportionately higher, in the first year, the gains could be lower because of the lower base, but as we move forward and the corpus increases, naturally the gain could turn out to be higher, also with a greater amount of return that we may expect in a year when the equity markets have done very well. It could be a greater gain that is arising. Even then, if we look at this example, in the entire summarization of the gain, which is coming up to 1,76,000 rupees approximately, there is exemption of 125,000 rupees available. So the taxable gain is just 51,000 rupees, which gives a tax liability of just 7,000 rupees. So practically, if you work out the rate of tax of the liability that is arising on the entire withdrawal, the income that someone is able to enjoy, it is not even 4%. So the rate of tax, effective rate of tax, is quite minuscule as far as the SWP planning is concerned. Moving with the second avenue, which is portfolio management services, in which there is a equity shares portfolio which has been created for the investor, but the entire job of which stocks to buy, which stocks to sell at what prices is outsourced to an asset management company. What happens is that for investors out of US, there is a regulation in US called PFIC, Passive Foreign Investment Corporation, wherein all the gains, even the unrealized gains, which have not been realized by way of sale of investments, are taxed on a notional basis, meaning even if the portfolio appreciates and we have not sold anything, the US taxpayer has to pay taxes on it. So for a PMS, this will not apply since there are individual shares which are there under the ownership of the individual investor. So this could be a very effective planning technique to take exposure in the Indian equity markets without having the liability of an unrealized gain or a notional taxation kind of a working. Also, similar to a mutual fund, in case of a PMS, there can be a separate annual exemption of 1.25 lakh of rupees, since those are equity shares, and this limit of annual exemption is available in equity shares as well as mutual funds. And HUF can also start a PMS because it can own shares on its own individual capacity to take advantage of this limit. What happens is that in case of a PMS, the shares are regularly bought and sold across the year, which leads to certain capital gains. Of course, there is an exemption limit which is available, beyond which it is taxable at a flat rate. In this entire process of the churning of the portfolio, what happens is that the profits are booked and reinvested. So the cost keeps going up. The investor keeps paying tax naturally, and the cost of acquisition keeps increasing because whenever the proceeds are realized, they're invested back at a greater cost in the equity markets. If we look at the past trend of the tax regime in India, there's been a consistent increase in the rates of capital gains tax as far as equity markets are concerned. Something that was tax free earlier was taxed later at 10%, which is now taxed at 12.5%. So we are very clear, and we can definitely foresee that there will be a rate increase in equity capital gains tax over the next few years. So it is definitely ideal to book gains and pay taxes at lower rates rather than accumulating those gains and paying taxes at a higher rate in future. Guaranteed income plans are very popular means of building fixed income in a tax-free manner. What happens is that there is a death benefit alongside of this guaranteed incomes because it is issued by a life insurance company, and there is a limit up to which if investment is done in per individual in these kinds of plans, the entire incomes are tax free for very long tenures. So up to 5 lakhs of rupees per individual, as per the present tax laws, any income that is earned by way of guaranteed income plan is tax free for a very long time. So in a family, there can be a HUF which can be started, and this HUF, along with the individual family members, can start a guaranteed income by investing into these kinds of plans for an ongoing basis. So the total tax-free income, when every individual and including the HUF is paying 5 lakhs of rupees every year, can be very substantial. Also for pension incomes, if the way there is a TTAA benefit in several countries, the way we understood, including Kenya, Uganda, Singapore, and many other Southeast Asian, African countries, there is also a tax-free exemption available for pension incomes which can be attained. This is the entire practical illustration of how this plan works, wherein there is a 5 lakh rupee limit up to which there is tax-free income which can be enjoyed, beyond which someone can definitely contribute and attain a higher income, but then it becomes taxable. So to keep it tax-free, we have illustrated with example of 5 lakhs of rupees, which if invested for let's say 10 years with another cooling period of 1 year, then thereafter from the 12th year, there can be a regular income which can be generated of at least 4.5 lakhs of rupees or very long tenures, as long as about 40 years, as we have illustrated in this working. What happens is that during the entire course of these 11 years, there is a death benefit which is associated, which is payable to the investor if something, if an unfortunate event happens. And thereafter, this kind of income is guaranteed, come what may. In the eventuality of the death of the policyholder, the nominee of that policyholder can enjoy this income for 41 years. So this plan, the idea is that whatever happens, let's say whatever happens in the equity market, in the economy, in the interest rates, as we are in a declining interest rate scenario, there could be further reductions in the times to come in the interest rates that are offered by the banks. Even in such a scenario, this kind of income, which is offered by a very reputed and institutional kind of a life insurance company, is something that is certain and can keep going on with the time. This is a completely customizable kind of a plan, meaning if someone wants to contribute only for 5 years, even that is possible. And if someone wants to delay the income so that there can be a greater income which can be received, even that is possible. If someone wants to reduce the income so that there is a final lump sum benefit which can be attained at the end, which could be greater, that is also possible. It is all dependent upon the particular individual. Real estate is also a popular means which a lot of NRIs have in India. Even though we are of the view that financial assets are a much better means than real estate as far as the income investment planning is concerned. However, if there is a real estate property which is already there, then all the expenses which are incurred by way of transfer of the real estate, meaning there is brokerage paid, stamp duty that is paid, And if there are repairs and renovations which are done in the property, which is cost of improvement in the technical words, then all this can be reduced from the sale consideration that is received at the time of sale to reduce the overall gain component on which capital gains tax liability may be calculated. So this will help to reduce the overall tax liability arising out of sale of the real estate property. Many a times what can also happen is that a property which is purchased can be purchased in the co-ownership of different family members. In the co-ownership with the spouse or with children or with parents, so that basically the entire tax liability can be divided, because beyond 50 lakhs of rupees of gains, there is the additional surcharge which is applicable depending upon the amount for the tax liability. So till 50 lakhs of rupees of gains for every individual, the rate of tax is same at 12.5% plus cess. But if it is exceeding this, which is normally the case in so many of the real estate properties, if it is divided, if the share of each individual is lesser than 50 lakhs of rupees, then the surcharge is not applicable. So the rate of tax ultimately comes down. There are a lot of exemptions that are also available to reduce the taxation on sale of immovable property, which is when the property is sold and there are certain bonds in which if they are reinvested, the proceeds are reinvested within 6 months, and to the extent of 50 lakhs of rupees, there is no capital gains tax that is applicable. Then if there is a residential house that is sold and if the proceeds are invested back into another residential house, then the entire gain component is not taxable. And if there is any other sale by way of equity shares or any other property or mutual funds or whatever, and if those proceeds are invested back into a residential house, then to the extent of which the sale amount, sale consideration is invested to that percentage level, the entire capital gains tax is exempted. Gift city is something that has come up in the last few years in India, and I am sure a lot of you would have come across this in some or the other way. Now, before understanding the tax-free tax planning that can be done through Gift City, let us first understand as to what is this Gift City all about. Gift City is the first international financial services center in India. It is like any other global financial center across the world, which is like DIFC in Dubai, Singapore, Hong Kong, London. What happens is that this entire region, which geographically is very much in India, in the state of Gujarat, but is not a part of India as per the exchange control regulation, which is FEMA, is concerned. It is a special economic zone or financial services. So any other activity, to be manufacturing, trading, does not have any kind of a benefit in this area. And there are a lot of tax exemptions or tax benefits which are provided to financial services activities that happens in this area. The entire GIFT City framework is governed directly by the central government of India and through a unified regulator of IFSCA. The International Financial Services Authority has got powers of all the regulators, including SEBI, IRD, RBI, PFRD, which govern financial markets, banking, pension, insurance, all different activities, so that there can be a faster mechanism through which the working can take place. Now, this is how a person who is outside of India can take advantage of the GIFT City ecosystem. Any investor who is outside of India, be it a person of Indian origin like all of you, or a person who is not a person of Indian origin, or even a corporate, a company registered outside of India, a trust, any other entity outside of India can invest in a GIFT City fund. It is called as a alternative investment fund in the technical terms, which invests in the Indian mutual funds. Now, what happens is that ultimately we are taking exposure in the same old mutual funds, which we have all been investing since a very long time, which invest in the Indian stock market. But the idea is that since it is rooted through this city fund, then whatever are the taxes, they are completely exempted in India. There is no tax liability that arises in India. Since there is no tax liability, there is also no requirement of obtaining a PAN, and there is also no requirement of filing a tax return. And naturally, there are the tax assessments do not come into picture. There is also a requirement of opening a bank account or a demat account moving beyond taxation. And all these investments are denominated in USD, and the funds would travel directly from outside of India, any bank account outside of India, and would go back to that very account or any other account outside of India, including the NRI account. So if someone has got funds in the NRI account, it can also be used to transfer the funds. The only thing is that there will be currency conversion from INR to USD or USD to INR, as the case may be. And the onboarding process is also very simplified. To summarize, this is how it will work. Wherein the investments are in the AIF, AIFs would invest in the mutual funds, which invest in the equity shares. The entire gains proceeds are tax-free to the investor and also to the fund. Even when the fund sells on behalf of the investor, there is no tax. And even when the investor sells, if their own investments in the fund, there is no tax liability and everything can be repatriated seamlessly. There is no advantages, there is no tax implication, no requirement of bank or demat account, all denominated in USD. There are several different GIFT City funds which are now available by so many different asset management companies in India, investing into different kinds of stocks, mutual funds in India, across the globe, and in different asset classes, equity, debt, hybrid as well, starting with a different level of minimum amount requirements. And the taxability for each fund is separate. It is not that each and every fund which is registered in GIFT City is tax-free for the investors. This is a major misconception which so many of the investors have. Therefore, it is utmost important to understand the nature of the fund, and thereafter we can decide on the taxability of the fund on a case-to-case basis. So, understanding taxability of each category is very important. There are many investors in several parts of the world who have been receiving a lot of queries from their local tax administration authorities for the investments that they have outside of India, outside of their own country of residence, maybe in India or any other part of the world. For them, this could be a very effective structure. Let's say if a person is residing in any country and is required to disclose the income, bank accounts, and assets outside of India in that particular country where they are residing, which would definitely include the Indian investments and Indian bank accounts, since it is outside of their own country where they are residing. In this scenario, GIFT City funds could be a very good solution for the reason that the GIFT City fund would be then investing into multiple mutual funds. So what would happen is that on the face of it, it would look like a particular mutual fund. To give an example, Tata GIFT City Fund. But this fund would be investing into several different mutual fund schemes in different sectors, different themes, and would be shuffling that from time to time to take advantage of the market opportunities and trends. However, the tax incidence on this would only arise when the entire holding in the GIFT City fund, for the sake of the example, when the Tata GIFT City fund itself is liquidated by the investor, only then there could be a tax implication in their own country. India is not going to tax, as I mentioned, as I repeat, but their own country may be taxing them, but that would only be later when they redeem the investment. Till then, there can be a very good deferment of taxation, meaning prolonging the taxation, and at the same time, the underlying investments remain agile and active, and the entire investments are very optimally managed so that they can keep growing with the times. The way we work for GIFT City ecosystem is we have office there, and we have an entire data matrix through which we prepare the key performance indicators to select and to select the best suited scheme with the underlying performance and investments. The underlying investment is definitely important. We are uniquely positioned to advise not only from the viewpoint of investments, but also the exchange control regulation and taxation ultimately. All these three are very important for anyone who is investing in the city framework. So case by case analysis has to be done. And it is not that a particular type of big city fund would suit all the investors. It all depends upon the country from which they are investing, the financial profile, naturally, of the person, the kind of risk the person is willing to take, the liquidity arrangement. And through this, we have onboarded several investors across the globe successfully. A general disclaimer that all the views in the presentation were personal, and we have used relevant references wherever we have used any data. A glimpse of our past webinars in our endeavor to educate and empower the Indian diaspora completely in terms of the financial planning. And we'll go on addressing this in form of several other webinars on different topics. We've also been conducting a lot of in-person events globally, last one being in Kenya and Uganda, and we were fortunate to even meet so many of you there. We will also continue doing that so that we can meaningfully engage by way of a personal interaction as well. A brief about us before we end this. We have a legacy of more than 65 years being a one-stop solution provider for all kinds of financial services requirements. And we have a total team strength of about more than 65 persons in all different domains of finance, with active office presence across 5 different locations in the western belt of India, cumulatively managing more than 150 million US dollars of assets, predominantly in the Indian markets for all our investors, and also in the global markets for more than 5,000 clients spread across 30 plus countries. The services that we provide to explain you is number one, investments into all kinds of different avenues in the Indian equity markets, mutual funds, PMS, AIFs, which are beyond the listed equity, which is the unlisted space in India. And also we are very active on the global investing funds in the US market and several other global markets of the world. GIFT City is, as I mentioned, is a very popular means for any Indian origin person living outside of India, invest in the Indian market in a seamless and a convenient manner. Indian income tax and accounting also, we are very active as far as the entire compliance framework is concerned, as well as tax assessments in terms of assessments at every stage. And tax planning is the topic of today, is also our forte for any individual. Estate planning is also very important as far as wills are concerned for all the assets that someone has in India, as well as for private family trusts, wherever there is a need to do so. We are insurance brokers for life insurance. So we deal with all life insurance companies in India in form of the guaranteed income plans or pure life coverage or any other plans. International tax compliance report, as we understood today through a sample that was presented earlier in the presentation, wherein whatever are the incomes and assets that are there in India, we help a person living outside of India report those conveniently in their own currency as per their own tax year, so that the entire compliance in the country of residence can be met with as per the DTAA and the tax law of that particular country. Regulations, as far as all financial regulations are concerned, be it repatriation of funds or planning for any other transactions, gifts, loans, is something that we advise full-fledged. Coordination with the bank is also something that we support wherever there is a need to do so. For anyone who is working with us, there is a single point of contact for anything and everything that they can think as far as Indian financial affairs are concerned. There's like a complete family office arrangement for them in India. And this is all possible through a single point of contact of a relationship manager from our team, who is backed by all different specialists in the domains of finance, which brings a lot of convenience. The person who is working with us and also to us in terms of discharging a holistic advisory and eases our tax compliances for the client. As far as our charging mechanism is concerned, then basically all the ancillary services that we provide, including the income tax advisory, compliances, the estate planning support, bookkeeping, regulatory advisory, every other thing is all complimentary from our side. We do not charge anything for that, for all of that. The only condition that we have is that the investment portfolio should be managed by us, so that, like any other financial advisor in India, we are remunerated by way of brokerages from the respective asset management companies. It takes care of our remuneration, and thereafter, every other service, as I mentioned, we provide without any cost. So this brings a lot of advantage to the person who is investing, because the they do not have to bear any kind of extra costs. And brokerage by the asset management company is something that any is applicable to any other financial advisor in India. If someone has got their existing portfolio in India in mutual funds or PMS, then there is something called as a change of advisory or change of distributor, which can be done, so that basically they can take advantage of our complementary services by mapping that portfolio to us without any charges, because that portfolio can be also managed efficiently, and we can advise from the investments perspective as well, and with all other value added services, as I mentioned, without any additional costs. If any one of you happens to visit any of these locations, then it would be a pleasure to meet you and interact with you in person. And thank you so much for sparing your valuable time. A humble request that we would have shared, someone from our team would have shared the link or the feedback for today's session. And please provide us with your valuable feedback, so that, number one, we can help you serve better, and we can improve wherever it is possible in the upcoming presentations and any other kind of knowledge sharing events that we do for you. And secondly, it would also help us get your contact details, so that we can share the entire presentation with you, which you can refer later at your own convenience. A special thanks once again to all the participants for making this on a weekend, which is valuable to everyone. And looking forward to connecting with everyone soon. Thank you.